If you have held an investment property for 10, 15, 20 years or even longer, this one's for you. You most likely have watched the property price go up, watched the loan shrink, and figured things are going pretty well. And honestly, they probably are. But there's a quiet shift that happens the longer you hold property, and most investors are not fully aware of it. Today, I want to walk you through what that shift looks like using a simple example so you can see exactly where your own property might be sitting and what your options are. Let's start right at the beginning. Say you buy a property for $1 million, the bank lends you 75%, so $750,000 comes from the loan, and you put up the remaining $250,000 in cash. That $250,000 is your equity, the portion of the property that's actually yours. Everything else belongs to the bank at this point. The initial picture is quite clear, but it doesn't remain still for long. Every month, two things are quietly happening in the background. Firstly, your mortgage payments are chipping away at that loan. As you can see here, the outstanding loan shaded in grey gradually becomes zero, while accumulated principal repayments become your new equity. Secondly, as property prices move up in tandem with secular economic growth, the property is worth more than what you have paid initially, and that increased wealth is reflected in the light green portion of the bars. Both of those things grow your equity. Look at how this plays out over 30 years. That original $250,000 investment turns into something much, much bigger as the loan shrinks and the price climbs. Let's strip away the loan completely and just look at what's actually yours. Your initial cash outlay, your principal repayment, your price gain stacked together. Look at the equity growth. By year 30, on a property that started at $1 million with $250,000 cash outlay, you could be sitting on well over $2 million of pure equity. That's a lot of capital parked in one asset, and that's exactly where things get interesting. You might be asking, as the power of equity keeps growing, what return are you actually earning on it? This is return on equity. Basically, how much you're making each year divided by how much of your own capital is tied up in the property. More formally, ROE is equals to total return for a year divided by equity at the beginning of each year, where total return for a year is a summation of net rental cash flow, principal repayments, and price change. When you plot this ROE on a chart, it tells a pretty different story than the equity chart. In year 1, you might be earning something like 15-20% ROE. By year 15, that's down to single digits. By year 30, you're down to somewhere around 5%, based on our example. The property hasn't gotten worse. Rents haven't collapsed. What really happened is that your equity base has quietly ballooned, while the actual dollar return sitting on top of it hasn't grown anywhere near as fast. Let us look at the two components of the ROE ratio. First chart on top represents the total return, our numerator. Second chart at the bottom represents the equity, our denominator. On top, you've got three things that actually generate your return: your rental cash flow, your principal repayment, and your price gain. And the line shows your total return once you add them all together. At the bottom, you've got equity climbing steadily year after year. Notice something. In the earlier years, rental cash flow can actually turn negative. The mortgage payment costs more than what the rent brings in. That's normal for a highly leveraged property. But even once that turns positive later on, the total return numbers just aren't growing at the same pace as the equity sitting underneath them. That gap between how fast your capital is growing and how fast your returns are growing is best illustrated in a chart showing their relative growth path indexed to 100%. As you can see, throughout the holding period, growth rate of equity outruns the total return every single year. Naturally, the ROE will decline over the same period, reflecting this unequal growth path. This is what people mean when they talk about equity getting trapped. It's not that the property is doing badly, it's just that more and more of your capital is trapped in your property doing less and less work. Now, none of this means you did something wrong or you need to panic and sell tomorrow. It's just that the situation is worth a review. Broadly, here are the paths investors can consider. Continue holding on to the property and perhaps extract some equity through a mortgage equity withdrawal loan subject to regulatory limits. Refinance to optimize your financing on more favorable terms. sell and recycle that equity by buying a higher value investment property using leverage again. Or invest part of that released equity into other asset classes, or perhaps use the equity to improve your retirement cash flow through low-risk annuity-like investments. Every one of these has its own trade-offs, and the right one really depends on your own goals, your age, your risk appetite, your tax situation, and what the rest of your portfolio looks like. If there's one thing you can take away from this, it is that you should actually run your own numbers. Once you see the equity and the return side by side, it becomes a lot clearer whether your capital is still working as hard for you as it used to. If you would like a personalized look at where your own property stands, drop a comment below or reach out and I'll be happy to walk it through with you. See you in the next one.